Good morning and welcome to the investor webinar for Nutritional Growth Solutions, a global nutrition company creating clinically proven products to support growth and development in children. My name is Chloe Hayes, the Investor and Media Relations Manager, and today I am joined by CEO Steve Turner. Today's webinar will start with an overview of the recent announcements, which will be followed by a Q&A session. And to ask a question throughout today's webinar, please use the Q&A function at the bottom of your screen. Yesterday, NGS provided the market with an update on the company's North American expansion strategy. And to tell us more, I'll now hand over to Steve.
Thank you, Chloe. It's very exciting times for the company. We've actually been continuing to deliver on our expectations to grow the business. Our retail footprint is continuing to grow. We're now officially in 465 doors of Walmart, which represents an increase over where we were previously. In addition, we're already seeing the positive increase on our sales velocity, both as incremental numbers as well as just what we're seeing in POS as far as point of sale sales with consumers. At the same time, we've made some pretty significant expansion plans with additional retail partners. We're beginning onboarding with CVS's alternative store formats, which is currently a variety of different banners, accounts for roughly 1,500 doors in the US and in Latin America and Puerto Rico. The final store count of that assortment will be selected at a later date, but it is a pretty interesting opportunity for us because the merchant team that approached us was very energetic, very engaged and interested in the brand. And we're looking at actually creating a physical merchandise display that will prominently display our brand along with two others to drive awareness and create sort of a destination within their existing store footprints that just helps raise awareness and again, drive sales and draw people towards a children's nutrition set within their store format. Onboarding will take several months, so the process is just beginning, but we really wanted to get the news out so that we could talk about the fact that this is just one of the things that happens as we continue to build momentum with the brand and awareness based on what we've accomplished both online, but more importantly with Walmart. In addition, we began onboarding with iHerb, which is a global e-commerce company that actually specializes solely on health and wellness products. The vast majority of their business is actually outside of North America. So for us, it's a nice incremental play, but more importantly, it gives us access into markets where we would have difficulty entering, where we'll actually be in their portfolio, in their storefront, and basically they'll be doing the marketing and heavy lifting and promotion of our products. And we can siphon off and spin off our inventory from US operations. We actually service their account right here in California, not far from where our operations are. And it gives us the ability to basically bolt on incremental sales. The nice part about it, again, is because they're doing all the work, it's sort of hands off for us in the sense that it's not a resource drain. And it gives us a much better opportunity to sort of build the brand, test awareness in markets like on Tmall and JDE and Redbook and Rakuten in Japan and other Asia Pacific regions, which is really where iHerb is pretty significantly positioned. And those activities actually are happening fairly quickly. We expect our initial orders to be within the next 30 days. Initial orders will be a small figure that basically is going to be product enough for them to get the pages set up and begin the merchandising activities. And then we'll monitor sales in a very short period of 5 to 7 days, and that'll set sort of that level set expectation. But for me, having worked with iHerb in the past with other brands, I expect them to be roughly 20 to 30% of the total magnitude of our existing e-commerce play, which is pretty sizable. And we're also going to make sure that we put incentives in our relationship with them that ultimately drive growth. One of the tactics that I've used in the past that's very successful that we'll be using with iHerb currently will be basically to drive towards a goal as far as an annualized sale number over a 12-month period and provide additional incremental contribution as far as the margin play in quite literally write them a check essentially for successful efforts if they're able to achieve that milestone, ultimately just to drive the business. And so those are some of the tactics that we'll be deploying in order to basically drive more growth in incremental sales. And then on top of that, we've done some significant changes to the business and how we operate. We've gone through some pretty significant restructuring that's allowed me to right-size the organization. We've cut out quite a bit of spend or burn that we had as a business up until these changes that actually the net benefit for us is to allow us to focus on what we're doing for our base business, get healthy, get our run rate down to a level where from an operating standpoint in the US, it's nearly break even. And then from an overall corporate structure, it gets us to that break even point much sooner. So still anticipating that that's going to be achieved given what we're doing now towards the end of the year. Could happen quicker, depends on really how quickly overall top revenues scale. But based on the current operating plan and what we're looking at, both with our base business and the cuts that were made, it actually puts us into a position where we're no longer a going concern, which is always nice. And then we can continue to operate with the revenues that we're generating. And then as the business grows, we then will take those profits back and put them into the machine and start investing the windfall as opposed to spending money that we didn't necessarily have at the beginning.
So we've had some questions come through over email, which I'll jump straight into.
Okay.
Our first one today is, once Healthy Heights has become a larger brand with a significant North American presence, what sales velocity could you achieve through Walmart?
Well, Walmart themselves, it's going to be a combination of sales velocity, but more importantly, points of distributions. So as we grow, ultimately, I would like to get into 80 to 90% of their footprint. That's where the lion's share of the revenues are generated in Walmart. And that would represent around 2,400 to 2,800 doors at peak if we were able to successfully do that. If we do that and maintain the sales velocities that we're doing now, which are north of 1, as high as 5, that actually puts us into a position where one item or one SKU on the shelf should generate anywhere from $3 to $5 million per item. And so our current assortment is 2. We have a third item coming in the fall. We know that we have another flavor of the 2 items that are on shelf that's performing well online. So I do have a pathway towards having 4 items on shelf. If we can get 4 items on shelf at Walmart and get to full distribution, that 80%, 90% footprint, then that should represent anywhere from a $15 to a $30 million potential business on 4 items. Again, when I look back at all the other brands that I've worked with, it's purely a function of sort of looking at the magnitude of the volume of business that Walmart represents and the fact that they're 35% or more of all things sold in North America. It's purely a function of seeing how quickly can we get distribution. So it's all about gaining real estate and getting on as many shelves as possible, as quickly as possible.
Right. When you refer to unit, how much is a unit of sales at Walmart? What size of package does this refer to?
So we're currently selling a children's nutritional protein shake mix that's in a small canister that represents anywhere from 10 to 20 servings, depending on age. And that's our unit. It retails for $19.48. So we generate $19.48 for every unit sold on every door that we're in. And the way Walmart likes to look at the world, as well as most of retail, is they look at revenue per inch or dollars per door. And ideally, you want to get into a position where you're making lots of money for, of course, your merchant team. So another way to look at it is if I had, just to do simple math, 3,000 points of distribution and I was selling 1.2 units a week, that's roughly $25. And so then I have $25 times the total number of points of distribution times the fact that there's 52 selling weeks in a year, and that's what gets you to your final number. So that's sort of how the math works itself out. So we currently have a luxury of the fact that our product retails for nearly twice what most of the items within that competitive set sell. So for every 1 unit that I'm selling, I'm actually outperforming from $1 per inch of all the other items on shelf because they generate $8, $9, maybe only $10 of income for that store. And so it's all about making sure that we have a healthy profit margin so that our merchants are happy and that we have healthy velocity but are generating revenue. And that's ultimately what we're trying to do.
In the March quarterly, it mentioned that 69% of sales came through Amazon. Is it possible to drive further sales through the company's own websites at a higher margin, or are margins the same through Amazon and the company's web store?
Well, the margins actually vary dramatically by channel. Amazon back in the day used to be everybody's dream because you could keep the delta between what you sold to a consumer and what you bought your product for. That's not the case anymore. So the cost of selling on Amazon on average is roughly 35% of your total gross revenues on any given item, because you have merchant fees, all of your logistics, fulfillment services, plus the requirement to spend on marketing in order to basically make it move. If you don't spend, obviously, then everything just dies off fairly quickly just because of the competitive nature of that marketplace. Whereas on our Shopify or our web store, healthyheights.com, we actually do keep the difference between what we buy our product for and what we sell it to the end consumer. But again, it's a smaller footprint and not nearly the magnitude or ability to attract as many people because it's our own web store. So we have to spend a significant amount of capital in order to basically drive foot traffic into our store, much more so than we would on Amazon. So we spend quite a bit of our margin on Google, Facebook, in the metaverse, through traditional media and a variety of other digital tactics in order to basically get them into our store, which is our website. So although the margins are more attractive from an actual selling and operating standpoint, there's quite a bit more need to spend below the line in order to basically drive that footfall. Net at the end of the day, we do make more money from a net contribution standpoint on our web store than we do from Amazon. Interestingly enough, we also make more money on Walmart than we do on Amazon. So even though Walmart enters the marketplace as a physical brick and mortar and that they take price leadership, meaning they're trying to basically sell for the lowest price in the market, they've structured it in such a way where as long as you understand the game and understand what's required and you have the ability to make sure that you have the margin in your product, it can actually be a very profitable business because there's just so much scale that they bring to the plate. It's much easier to be able to get a unit to move, given how big of the business that Walmart controls. And even when you compare Walmart to Amazon, it's important to know that they are more than 10 times the size as far as revenue and dollars generated than even Amazon is. And so, they're quite literally the largest. And so again, we're going to continue to chip away at channels, and every channel will have its challenge. And so there will be high-low accounts that will have lower profitability, but are part of that overall healthy ecosystem that we hope to continue to grow as far as where we get on our retail journey.
And Steve, could you touch on the company's marketing strategy in North America and how is this assisting in driving sales in the US?
So we do a variety of different tactics, but it all hinges on how do we have a conversation or engage with our end consumer. That's all that matters. And so we do that in a variety of ways. We use social media, both with mommy bloggers, daddy bloggers, but also healthcare professionals, because there's a lot of people in this world that have a kid in their environment. And so those are the people that we want to engage in. We want to be able to give them resources and give them content or a product that's fun to engage with and generate buzz. And so we use that buzz from a variety of different ways. We engage in some levels directly with the medical communities, which is where we started. And we have found a variety of different pediatricians have really grown to adopt our product. And so they speak about us and provide us basically as a resource for their customer or their client base, their patient base. But they're doing it in such a way where they're following sort of the Hippocratic Oath. And so, of course, they're not compensated in that regard. And so we are there really just by the merits of what it is that we bring to the plate. At the other end of the spectrum, though, we have other healthcare professionals that actually are able to then not only be advocates and voices for our brand, but also drive sales as well through affiliate relationships. And so we use a combination of affiliate relationships with a variety of different folks that are basically key opinion leaders in their world. And in some cases, they may be children. We do actually have several interesting social media influencers that are our target demographic. One example is we brought on board recently this year a young gentleman athlete by the name of Storm Russo. His father, Flash Russo, is a former Kansas City Chiefs NFL football player. And they have this youth football organization that is in a lot of ways both philanthropic as well as just fun and engaging for kids. And if the children make the team, then all of their gear, travel, and participation is funded by this organization, but more importantly, they're playing around the country. And he's actually been on our product. So he was a user of Grow Daily 3 Plus, which is our original core formulation, for the last 2.5 years. He grew 5 inches. And so he is literally one of our many disciples that we have out there that have been on the product, have seen positive results. And of course, he is an influencer for us. So he has affiliate relationships where they're actually doing the sporting games around the country and participating. He's engaging with other children of his own age, but also with other families that are looking to find similar results. And so we have a variety of these individuals that we like to use. And of course, that leads us to also earning exposure through traditional media. And we've had a number of placements where myself and members of our team or partners that we're affiliated with have been asked to be on national TV shows, snippets for a variety of different subject matters, so that we're actually able to get earned media coverage on TV in networks in and around where we actually have distribution. And all of that mix, all of that combined, along with a variety of other traditional tactics, banners, and so on and so forth that we use in the digital world, is what we do to basically attract consumers and get them into our store and hopefully convert them into a customer.
Right. And although NGS has already seen an increase in the number of Walmart stores just this month, when do you expect a further increase in stores?
That's going to continue. So interestingly enough, the formal clock for us on our business with the 2 protein shakes started mid-May, just 2 weeks, 3 weeks ago. That's the 1-year time frame that modular became effective. So all the stuff that we've been doing from a sales and exposure standpoint since last October was sort of just icing on the cake. So the next logical point, there's going to be 2 that we would see store increases, will be potentially during a mid-cycle refresh, which is when we got the opportunity in the first place. So possibly September, October timeframe, or the next formal reset of the modular, which would be May 15th, week 16 of 24. The one thing, however, that's interesting, and this is the part that we're going to continue to draw a flashlight to with the merchant teams at Walmart, is we are going into a new modular in September. So Department 40 is a completely different business unit at Walmart. We're currently in Department 79, which is their toddler infant feeding space. And we're going into their OTC pharmacy supplement space with our new Happy Tummies brand that we're launching in week 32, which is roughly the first week or 2 of September. That actual footprint is going to be 795 doors. So we'll actually have more doors of distribution for that particular item because that's how they elected to start that process. The total maximum potential for that particular category is actually even larger. There are roughly about 4,600 doors in Walmart that actually operate within Department 40. And so now we have 2 items in one department in 465 doors, and we have a new item going into a new department that's going to get a lot of visibility as well, that's in 795 doors. So we're going to use that hopefully as a lever in order to basically try to get the 2 merchant teams to say, hey, you know what would be really great for everybody? Let's level set the store count across the board, and then hopefully we'll be the net benefit of having a windfall of doubling our footprint on our existing business.
And Steve, with the cost reductions you mentioned earlier and based on the expected revenues, when do you expect to reach break even?
Well, interestingly enough, the US piece, what we're doing specifically within our corporate headquarters and managing our existing Healthy Heights brand with these changes actually is scratching at the coin of being break even as early as the 3rd quarter. Realistically, though, when you look at it from a corporate standpoint, because of our audited public financial requirements and everything else that we have that's going on around the world, that's probably going to still be 4th quarter, beginning of 24 event. But because of the changes that we made, even with the operating plan that we have, if we are conservative and scale back or discount those expectations internally, we'll still have funds in the bank to continue operating in order to basically continue to build towards that point. But as far as our overall break even as a company, it's going to be somewhere in the either 4th quarter or early 1st quarter of 24, all dependent on how quickly things scale. So what you're going to want to hear from us and from me on a regular basis is, Have you gained more distribution? Are you still meeting merchant expectations? Have you found a way to basically continue to grow your top line revenues? Because that is all going to be the windfall that allows us to push forward that break even point sooner.
Right. And Steve, is there a sales opportunity for Healthy Heights products in South America? And if so, are you currently in discussions with retailers there?
There actually is a sales opportunity for Healthy Heights products everywhere on this planet. But obviously, what we need to do is do it in a way that is a little bit more tactical. And yes, the answer to the question is there is interest, and we've actually already begun engaging that. So Walmart Central America actually already has a group that we've been in discussions with. Where they actually have 900 points of distribution uniquely throughout not only Mexico, but all the way through Central America and the tip of the tail above South America as well. And so it gives us the ability to leverage what we're already doing with Walmart in such a way where we can get individual registrations in each of these countries in order to basically put through the Walmart pipeline in order to get sales throughout Central America. It's a long play. I will tell you that registration process, working through that overall routine to get items set up, is a year and a half or more. And then, of course, we have to be conscious of the fact that we are a premium brand, and so we won't be really very successful in price sensitive markets. And so there's only going to be certain zones within Mexico, for example, and Central and South America that are going to make sense for us. But again, it is part of the plan. Not only that, but also Australasia, Asia Pacific, Europe, China, obviously North America, beyond the borders of the US, up into Canada as well. All of that's in our plan. It's just doing it in such a way where get healthy, sustain growth, demonstrate that we have the ability to continue to grow, share price gets reflected, gives us resources to then be able to do more with the stuff that we spin off at the top as opposed to spending from below.
And on that note, do you plan to launch the products in Australia?
Absolutely. We actually have a couple avenues that we are currently pursuing. Our product qualifies as a food for special medical purpose. And because it's a food supplement as opposed to a dietary supplement, there are avenues where we are currently exploring bringing the US Grow Daily range into the independent pharmacy channel. But we also have the ability to service the last mile on Amazon Australia and sell the US product by way of their export hub, which actually exists in South Korea. And the luxury about that, of course, is the end user becomes the importer of record. And there's a VAT and duty waive for every individual. So there's no VAT or duties on those transactions as well. So it gives us the ability to very economically basically sell product to Australian consumers in a variety of different channels, both physical, in-store distribution within the pharmacy channel, as well as e-commerce as Amazon Australia starts to grow and hopefully replicate the way it is in other countries around the world.
Right. And Steve, could you touch on the New Zealand manufacturing plant? Do you still plan to manufacture there and sell into China?
We are currently shuttering that activity. So the manufacturing that we did at that particular facility was specifically for the China business. The product that was created was specifically for the China consumer. So it has a very different flavor profile than what we're marketing and selling in the US and what we intend to market and sell in Australia, because it's just a different palette. That particular product, we're working to basically continue to find a way to essentially make ourselves whole, get through that inventory, and then ultimately reevaluate whether or not that makes sense to continue operations there. But at the end of the day, it really depends on unlocking the Chinese marketplace. So the challenge that we had in the past is we were attempting sort of a pseudo Diagao e-commerce exchange business model that, as we all know, several years ago sort of fell apart, and we were operating sort of out of sync of the reality of really what the market will support. That's now starting to come back. So there is a potential that that would make sense in the future. But for right now, it's all about focusing on what we know is working, what is generating the revenues. And then we'll do everything that we can in order to basically clean up that business so that there is the potential opportunity in the future if we decide to reboot it at that point in time.
Okay. After the restructuring, what is the approximate quarterly cash burn and how much did the changes reduce this by?
Our total change that we made from a complete organizational standpoint, we carved out nearly $2 million from an annualized basis of burn. When you look at our financials and when you look at what our average burn rate is as an organization, it was roughly $5.5 million, and we're now down considerably from that point. So when you look at our current burn rate, we're in the neighborhood of somewhere around 3 million in total, give or take, from an annual basis, as opposed to the five and change it was before. And so, obviously doing the math on that, that basically is why when you look at what our current sales and what our current operating costs are, that we're getting very close to that break even and cash flow positive point fairly soon.
Right. Given iHerb's extensive global coverage, will sales be geographically focused on a certain region, or will you utilize the iHerb agreement to build the brand and sales wherever you can?
I'm going to basically do everything that we can in the markets that make sense. Again, 95% of what they're going to generate revenues on is going to be outside of North America. They are significantly positioned in China. They're significantly positioned throughout Asia Pacific. And there's an opportunity there because their sole focus is health and wellness products only. They're not Alibaba selling everything. So they do have a pretty efficient way to move inventory as long as it resonates with the end consumer. So what my hope is and expectation is with iHerb is that they will give us the keys to be able to generate that much needed awareness, get exposure in markets that we would have difficulty entering to help build the brand. And then that halo effect generates search. And when people are searching, again, that helps raise and elevate the number of eyes that we're going to see in North America as well. So I do expect it to give us a lift in our base business, but also bolt on incremental sales because we're going to be in markets that currently we wouldn't have the ability to enter.
Steve, could you elaborate further on the NGS supply chain from manufacture through to distribution and sales?
Sure. So in the US, we manufacture our product in the US. It's actually blended and manufactured by a contract manufacturer that we work with in Utah. Packaged goods go straight into our fulfillment centers. And from there, it's basically split between our fulfillment centers that service Amazon and our web sales, or the fulfillment centers that service our retail facing activities with Walmart. And then it's just a matter of basically making sure that we have the inventory coming in to offset what's going out. And from there, it goes either physically to Walmart's distribution supply chain channels, which is their fulfillment centers and distribution centers around the country, straight to the stores. Or of course, we're servicing Amazon's fulfillment centers as well, shipping truckloads of product up into their warehouses that they use to sell when we're selling products on Amazon. So the only product that we actually pick, pack, and sell directly to the end consumer is what we do in our fulfillment center specifically for our own web store.
Do you expect inflation to impact production costs, and would this affect profit margins?
Inflation will always have a challenge, but interestingly enough, we weathered a pretty significant storm that directly impacted our cost of goods prior to that with the volatility in the whey protein markets. So we're more susceptible to challenges in production as it relates to protein powders and making sure that we have the ability to source materials in a variety of different regions around the world in order to sort of manage that volatility. So that is purely a function of supply and demand for different types of these protein isolates that the producers make. And of course, they're going to sell to whoever's demanding or paying the most. So we had out of balance challenges with different types of proteins that caused a lot of price increases in our raw materials over the last several years. They've actually gone down. So the net benefit of us is, of course, that inflation demand reducing overall global consumer demand has reduced consumption. That's allowed actually some stability within our raw materials that we depend on, the primary ingredient being protein. So interestingly enough, our costs haven't been impacted. Really, it's more of an artifact, or what we would see is if we were an established fully distributed brand, which we're not, then we'd probably see a decline in sales because we'd see lower velocity on shelf. But we have the luxury of emerging and starting out in this current time frame, so we have not seen inflation be an issue.
Right. And as our final question, Steve, could you please explain sales velocity? Does a sales velocity of 1.15 mean that NGS is selling 1.15 products per store per week?
Yes, in simple terms, it's exactly what it means. So what sales velocity is the number or the fraction of number of units that you sell on average in a store in a time, and in this case, in a week. So if I had 10 stores that I was selling my product in, and I sold 8 bottles of product in those 10 stores in a week, my sales velocity would be 0.8, or 8 out of 10 units, or 0.8 of a unit. And that's how companies like Walmart sort of view the world, because they have so many widgets on their shelves, so many points of distribution, and there's so many factors that generate either seasonality curves or whatever, and they have to plan accordingly. So they sort of look at it in that regard. So when I say that we have a sales velocity of 1.5, that means that in that time frame of a week, in the 465 doors that we are in, that we've sold 1.5 times 465 doors of product in a given week. And what's important to know is, what's the repeat purchases? Are we getting customers back in the store and buying another bottle? And that's, of course, why we want to look at it week over week, month over month, quarter over quarter, because you're going to see those consistent trends. And if you don't demonstrate the ability to sell volume and repeat volume, obviously then your time at a retailer will be short. And what we've been able to do is exceed those expectations, because keep in mind, as I've shared before, the merchant team's expectations when we started this project was, show we can sell at least 0.5 units in however many doors that we give you. So if you have 400 doors, show me you can sell 200 bottles in a week. If you can do that, then you're generating more money, or equivalent money, to what I'm used to getting from all these other brands that are in the set. If you can beat that or sell more, now I like you because you're making me more money. And so that's the game. And that's basically what we're doing. So it's literally as simple as saying, I have a bottle, or I have a pen, and I have a shelf that pen sits on, and how many of those can I sell in a week's time, given the magnitude of my business? And that gives me a number, and then you monitor that. Now, what's exciting is when I look at the POS every day, every week, we have stores that we're selling in velocities that are significant, meaning 4, 5, 6 units per week. And to give you an idea of how your head can spin with what that means is, imagine I had 1,000 doors and I was selling 5 units of product a week. Now you multiply that out, and the number that I'm projecting that we get to in 18 to 24 months time, if we can get full distribution, is exponentially even larger. So obviously that's, your proverbial pipe dream, but that's basically what Walmart represents as far as what they can do for brands, especially if there's a large amount of velocity returns, because consumers like your product.
Right. And Steve, we've just had one more question come through, which I'll quickly read out. Which countries does the company currently have patent protection? And could you please talk more about how the US patents create a barrier to entry?
Sure. So when the patents were originally applied, they were applied through the World Patent Treaty Cooperative Act. So we actually technically have coverage every geography, every state, every town around the world. But then when they went through the nationalization stage, we picked each of our major territories. I would have to go back through and pull a report, but we have in the issued patent portfolio coverage throughout pretty much every major territory that we would ever anticipate selling in. Including many that we probably would never get into as well. It was all just a function of how efficient we were able to manage the nationalization stage as each of those patents were going through their allowance stage. So we currently have an intellectual property portfolio of 6 issued patents. We have 1 composition of matter patent, which means the formula, the composition, the makeup of the product, and then we have 5 method of use patents. And what the patents allow us to do is, in the literal case of the composition matter, that's a very narrow scope. You can't make that. You can't mix those ingredients in any way, shape, or form, otherwise you infringe our intellectual property. But more importantly, the method of use patents are utilizing our formulations that we've done our work on within this range of ingredient mixes for the purposes that we're selling them for. So that prevents any other brand from doing exactly what we're doing. If we find another brand that has a similar composition of ingredients that's marketing for the purposes of growth and development in children, or linear height or lean muscle mass, or any of the particular claims that each of our unique formulations offer, then they're infringing our rights. And then we have the ability to then pursue them. And if you're found to be an infringer, you're liable for treble damages, which is pretty significant. So that's what the patents provide us, is the ability to basically to fight off the 1,000-pound gorilla that's out there that's doing similar products, but at least allows us to protect our particular space. And that's, again, when you look at, here's a segue, I apologize for everybody listening, but when you look at what makes our product unique, again, being a gap filler, being a food supplement that's not meant to replace the meal, that's a significant separation from Abbott and from all these others that are in this space that are making meal replacements. And so it gives us the ability to, again, to sort of operate within our playground and defend that in a much easier way, and make sure that if anybody steps onto our proverbial ballpark, we shoo them off.
Great. Well, that's all we have time for today. Steve, thank you for joining us for this investor webinar. And for those who missed out, we will make a recording of today's webinar available on the NGS websites and social media platforms over the coming days. And if you have any further questions, please feel free to reach out via the contact details at the bottom of our ASX announcements. Thank you everyone for joining us today. And thanks, Steve.
Thank you.